Hello, everyone, and welcome to the quarterly update with Q3 Asset Management. Just a little bit of a background of Q3. So Q3 Asset Management was founded by professional traders, and they seek to participate in rising markets and reduce risk when unfavorable market conditions occur, which we all know we have some upsides and we also have downsides to the market. Q3 believes that their background, coupled with their expertise in quantitative investing, gives them an advantage over traditional methods of money management. So with that, I want to introduce Adam Quiring, who is a partner at Q3 Asset Management. A little bit of Adam's background. Adam began his career on the trading floor of the Chicago Board Options Exchange, working for a proprietary trading group specializing in equity options. Then in 2006, Adam co-founded Q3 Asset Management, shifting his focus from trading to money management. He graduated from Northern Michigan University with a degree in business and holds the Series 65, which is a fiduciary license. During his time at Northern, a little background of Adam, he played point guard for the Wildcat basketball team. So with that, I'm going to have Adam give us some updates on a few of the strategies that we use in the Q3 Asset Management. And again, the goal is to help grow assets, but also help preserve with the uncertainty times that we have. Thanks, Adam.
Thank you, Carla. Appreciate the introduction. And we're just going to take a little bit of time here to go over Q3, explain to you our background, where we come from, and then dig into a few of the strategies in some detail. And it might be a little bit more information than some of you necessarily care to know, but we feel it's important to every so often share with you some of these details in regard to what we're doing and how we're doing it. So with that, our compliance department's contribution to the presentation here, past performance is not necessarily indicative of future returns. So Q3's roots come from the trading floors, myself in Chicago, as Carla noted, and our founding partner here, Brad Giamo, who's a little bit older than the rest of us. He started back in 1982 as a runner in the Gold Pit, 3 World Trade in New York. And at the time this picture was taken, he had just been recruited by a gentleman named Paul Tudor Jones, and I wouldn't expect you to know that name, but in the trading world, Paul is kind of the Michael Jordan of the industry. He's best known for many years of consistent returns, and Brad was fortunate enough to get to work for Paul for 3 or 4 years and learn all about trading and risk management, and many of the methods he learned there on the trading floor is what we employ today here at Q3. So what exactly is quantitative investing? Well, I know it's a big word, but at the end of the day, it's not overly complicated. Q3 uses statistics to determine when and where we're going to invest. So with each of our models that we employ here, there are certain rules that we follow that keep us true to our discipline. And at the end of the day, the stock market is nothing more than human emotion. It's fear and it's greed. And as a result, you tend to see these same emotions play out time and time again. And that's why you often see some of the same cycles occur in the market. And what our job is to identify market tendencies and these various cycles that occur and look to take advantage of them by either shifting your portfolio more conservative at times or shifting it a little bit more aggressive at times. So with all of our models, we have defined entry and exit criteria that determine where we're going to invest and when we're going to get out. So the Q in Q3 stands for quantitative. Everything we do here is based on statistics, like I just noted. In doing so, we take the emotion out of the investment process. And at the end of the day, our main focus is protecting what you have. The big goal is to avoid the big losses and keep pace with the market during the good times. And if we can do that, then at the end of the day, we come out ahead of the game. So we offer about 15 different strategies here at Q3. We're just going to talk about a few of them here today. All of these strategies are actively managed, some more active than others. We break them into 3 different segments, and Carla generally pulls a few strategies from each of these areas in putting together client portfolios. So we work very closely with Carla and ClearStep and their advisors, communicating what's going on so they can in turn do the same with you as the end client. So before we jump into the strategies, just a few market statistics here. You know, we've had a long streak here with the S&P not experiencing a 3% pullback, which is a pretty modest pullback in the big scheme. But the 135 days, that's actually the fourth longest streak over the last 35 years. So the market has been performing well here of late. After that rough first quarter, you know, it seems like it was a long time ago, but there was a point here where the market was down almost 20% on the year to start the year. And we've since bounced back with a vengeance, so to speak. So the market is probably due for a healthy 5% correction at some point, but it's no need to panic. That's kind of part of the game. It would actually be healthy here at this point. But we'll see, because the fourth quarter, which we're in right now, is historically the strongest quarter of the year. We've just, we're almost through October here. We've seen a very strong month for the market, right in line with the seasonal tendencies that we would expect. So, you know, from a seasonal standpoint, both November and December are historically quite strong. So we'll see how that plays out this time around. Jumping into the strategies, we're going to talk about a few of these. We'll spend a little bit more time on this first one, Bull Cipher, to give you a good feel for what it is that we're doing. We offer another strategy called Mercury that is a derivative of Bull Cipher, meaning that it uses the same signals, but does so in a more growth-oriented fashion. And Carla uses both of these strategies, so you may see these names in your portfolio, but we're going to tell you exactly what it is that we do. Before we do that, a quick statistic here that's quite interesting. I actually didn't believe this stat the first time I read it, but if you had only invested in the stock market on Mondays from 1900 through 2024, you would have lost more than 99% of your investment, if you can believe that. And this, of course, is a period where the stock market was up astronomically. Now, if you look at the chart here, you can see just how pronounced that phenomenon was for 9 straight decades, where Mondays were by far the worst day to be in the market. And then something interesting happened, and in the 1990s, Monday became the best day of the week to be in the market, as is the case here in the 2020s. And the moral of the story here isn't necessarily to avoid the market on Mondays, because despite the fact that worked very well for 90 years, it doesn't work so well here today. The moral is that when the stock market goes down, if you buy it, we call it buying the dip, you do very well, because we know that over the long haul, the market has a trajectory to go up. And if you use the pullbacks as an opportunity to buy, you do well. So this is a strategy that continually looks to buy the dip every time the market pulls back. It has a 9.5-year track record. You can see here it's done quite well over the years. A very consistent strategy. We like to say singles and doubles and avoid the losses. And, you know, it's not perfect. There's times where it's out of sync and it will underperform the market. But over the long haul, it's been a very steady performer for us. Now, I like to use analogies. This one likens the strategy to what a surfer might do in waiting for the optimal wave. And this is a strategy, Bull Cipher, where we're actually on the sidelines in money market about 40% of the time, waiting for that wave or that opportunity to jump in. So we're not interested in being involved unless there's what we call a high probability opportunity in front of us. Another analogy we like to use is the weather. You know, it's very difficult to predict 10 days into the future what's going to happen with the weather. The same goes for the stock market as well. There's just so many variables that can change the course of what's going to happen. However, if you shorten that time frame down to a day or two, both with the weather and the stock market, you can have a much higher accuracy in predicting what's going to happen. And that's what we're doing with the Bull Cipher, is looking over these very short periods of times where there's a dislocation in the marketplace that we can take advantage of. So the phenomenon that we just explained there, buying the dip, is something we call mean reversion. And how do we incorporate mean reversion into Bull Cipher? Well, we're looking to buy either the S&P 500 or the NASDAQ 100, so 2 major stock market indices, anytime they pull back with any kind of meaningful pullback. So what we like about the strategy, even though it's a long only approach, it actually performs almost just as well in bear markets as it does in bull markets. And as a result, it's a great portfolio diversifier. You can see March of 2020, which you probably remember this month well. It was the height of COVID. Oil went negative. The stock market was all over the place, mostly to the downside. It was down 12.5% that month. But you can see Bull Cipher actually had a positive month. It made money. And that was the result of jumping in, buying the dip when everybody else was panicking. Once the market rebounded, we get out and wait for the next opportunity. So this strategy actually looks to buy the dip over 3 separate time frames. So there's 3 independent signals, a 1-day, a 3-day, and a 10-day. And we're just going to look at one of these to show you visually what it is we're doing. And it happens to be the 10-day look back. So this is a chart, and it shows the NASDAQ with the blue line. We're in a bullish market regime because this 200-day moving average is underneath the market. So we're trending in a positive direction. And anytime the market closes in the lower tier of its trailing 10-day range, so that means we've got the highest high and the lowest low of the last 10 days. Anytime the market's closing in that lower tier, and we say right around the 15th percentile or lower, you're going to see a buy signal, and that's what the green triangle stands for. And then once we're in that position, once the market bounces, we get out. That's what the sell signal is, the red square. And so the signals you can see don't happen overly frequently. There's 5 trades over the course of this 6-month time frame, 4 of which are profitable, and this one here in the middle is a slight loser. So that's an example of how the strategy looks to buy the dips. Here's another example here in a downtrending market. And when the market pulls back, you can see our buy signals. When it rallies up, the sell signals. So again, it's a systematic approach that's focused on strategically buying the dips in the market and selling the rallies. And that, of course, is just one of many strategies in a portfolio typically. So you've got some strategies doing mean reversion, and then you've got other strategies doing other things, which brings us to Scarecrow Tactical Growth. And this is a strategy that is more growth oriented than Bull Cipher. It's kind of looking to put the pedal to the metal at times, investing in the NASDAQ when things look good. It's having a very strong month this month, up over 8% in October thus far. So now this is a strategy that we teamed up with a firm called Scarecrow Trading to bring to our clients and bring to Carla and others. They've been running their 2 flagship strategies for quite some time now. The first for over 20 years and the second for about 6 years now. And these are strategies that we've been monitoring for a while and offering to our advisors for a couple of years. And then more recently, about a year ago, we decided to combine these 2 strategies and create a model called Scarecrow Tactical Growth. And the mastermind behind this strategy is a gentleman named Len Fox out of Minnesota. You can see him here. So he developed this strategy, and we basically work closely with him to run the model for our clients. And this is a strategy I noted that combines 2 different models: Crow Chaser, which has been around for, again, over 20 years. It has won numerous awards through an entity called NAME for top performing strategy, and then another strategy called High Five. And we decided, instead of offering these 2 separately, to combine them into a single model. And we did that for a few reasons. The main reason being it reduces volatility, it reduces risk. You've got 2 different models instead of 1, just gives the clients a smoother ride. So the 2 components look at a variety of different indicators, anything from momentum, trend following, sentiment, which includes some mean reversion signals, and of course, seasonal timing, which I just talked about. There are different periods of the year where the market tends to perform better, and there are other periods where the market tends to perform worse. So all of these things factor in to the ultimate signal. And these 2 strategies, I noted, have been around for a couple years. You can see here the Crow Chaser, since we've been offering it since 2023. Again, they've been offering it a lot longer. but strong performance over this time period. The second model here, High Five, it's also performed well. We had a little bit of a dip early this year, but we've come back and we're sitting at new all-time highs. What you get when you combine the two, which we haven't been running as long, is a solid performance over the trailing 1 year net of fees, up about 23%. So that's what we like to see. And Carla's been using this one now for a good portion of this year. So you'll see, many of you will see this in the portfolio. But again, something different than Bull Cipher and different from the other models, all kind of working in tandem with one another to deliver consistent returns is the goal. So shifting gears here to another strategy, this one's called Tactical High Yield. This one is a more conservative approach, but we still utilize it for growth-oriented investors as a means of diversification. It focuses on the bond market, whereas the first two strategies we talked about focus on the stock market. This strategy has been very consistent for the last 45 months. You can see net of fees, it's up about 19% compared to the bond market, which is actually negative over this time period. And that, of course, is a good thing. Even though the strategy is more conservative, it doesn't necessarily mean it's going to track the bond market. It maintains the ability to kind of do its own thing, depending upon what the bond market is doing. So this strategy trades high yield bonds. That's one segment within the bond market as a whole. We like high yield bonds because they exhibit something called serial correlation, which is simply the tendency to trend. And when something trends well, we're able to overlay some basic technical analysis and create something that's a lower volatility solution than if you were to simply buy and hold high yield bonds. And we expect to be invested in the market about 50% of the time, and then on the sidelines in a risk-free money market account the other 50% of the time as well. And just an example of what that looks like, what I have here is a chart of the high yield bond market. So it's not necessarily the strategy, but it's what we're trading. And you can see this is from 2022. It was a bear market for both stocks and bonds. The bonds had a tough year, as you can see here, trending lower for a good portion of the year. When the trend is negative, we basically want to be on the sidelines. The goal is if the trend is not moving upward, then we want to simply wait it out. And you can see for just how long in 2022 we waited it out until finally getting a buy signal here in mid-July, which lasted about a month. And the trend was up for a period of time before it rolled over, at which point we get back out. So again, the old saying on Wall Street, the trend is your friend. That is what this strategy embraces and rides those trends when they're going up and looks to be on the sidelines when they're going down. Drawdowns, this is kind of a worst case scenario. The bond market, you can see, had a drawdown of right around 17%. But you can see the worst drawdowns for our tactical high yield strategy, which occurred here, was 3.6%. And all these other drawdowns are basically less than 2.5%. So by keeping the drawdowns low, this is one of those strategies where it's easy to sleep well at night knowing that the money is protected, at least to some degree. So that gives you a feel for some of the strategies that we're using here at Q3. Looking ahead, obviously we've had a nice run in the markets here of late. There's a lot of news on the horizon, from interest rates and the Fed to tariffs to all these different variables that come into play. And so obviously the market responds to these news events in different ways. You see volatility both to the upside and the downside. But at the end of the day, the key is trying not to let your emotions dictate your investment decisions. So, we are, with a lot of the strategies like Bull Cipher, when the volatility does come about, that's an opportunity. That's not necessarily a bad thing. It can be a good thing. And of course, now that we're in the final part of the year here, at least from a seasonal standpoint, things are looking good. So, the market's sitting right near all-time highs. Sure, we might be due for a little bit of a correction, but at the end of the day, a strong market and a strong seasonal time frame are two ingredients for more upward markets ahead. Of course, we'll continue to watch closely and adjust the sales if that's needed. So with that, I will turn it back over to Carla, and we'll go from there.
Thank you, Adam. So if you could also touch upon the New Horizons just for a minute or two. New Horizons is a strategy that we use in a lot of the portfolios just to pick up some of the AI, some of the blockchain. And so I'll let you talk just briefly about that, Adam. Thank you.
Okay. So New Horizons is a strategy that we've been running for a little over 4 years now. And as Carla noted, it looks at disruptive technologies, anything from blockchain to crypto to AI, electric vehicles, space, all sorts of cutting edge technologies. We invest in 5 different areas, so 5 different positions at 20% each. So it gives you some diversification in that space. And of course, it's having a great year this year, with that area of the market kind of exploding to some degree. It's has very strong performance, but what we do with that strategy is every week we look at over 30 different areas within that disruptive technology space, and we make sure that we're invested in the 5 strongest based on our analysis. So it's a trend following approach where the things that are performing best, we give the benefit of the doubt to continue to perform, and we avoid the weakest performers within that space. So it's become a more popular strategy here of late. It is more of a diversifier. So it's not going to be, the main strategy in your portfolio, but it'll be a smaller weighting within the overall mix.
Very good. Thank you, Adam. So I think we're finished, and thank you, Adam, for your time and expertise in giving us updates on a few of the Q3 asset management strategies. We plan on doing this quarterly. The next piece will be sometime in January to give us updates on the year. And if you have any specific questions, please reach out to your financial advisor. And thank you for joining us today. Have a wonderful day. Bye-bye.